How's it going, everybody? Welcome back to another podcast episode of Smart Money, Smart Moves with our CIO at Freedom Family Office, Kyle Cain. We do these weekly for you guys in 10 minutes or less, the same amount of time it takes your busy self to get a cup of coffee. There was a lot that happened in the markets this week, and so we're going to dive right into it with Kyle. Kyle, as we're recording this on a Friday, markets, specifically NASDAQ, is down over 2%. Markets pulled back a little bit after we saw all-time highs earlier this week. I want to unpack a little bit on the week, but what's the story behind the markets today? I know the job report came on. What can you share with us?
Yeah, so we're August 1st. We just finished July. As of today, jobs report came out, and and if you kind of heard which I'll talk about, um, the Fed governors Bowman and Waller, and what they've spoke about recently is that the economy isn't quite as strong as it may seem, and the job market is specifically. So, job report came out today, showing about 73,000 jobs were created in the month, below expectations about 104. But then even more so than that, the past 2 months were revised down by about 258,000 jobs. So that means June really only created about 14,000 jobs. The unemployment rate only ticked up from 4.1 to 4.2. But, and if you listen to Jerome Powell's speech the other day, he talked about, the job market and saying, in his opinion, that it's still solid. Why? It's because we do know that, we last year and the year before, we were easily 250, 300,000 jobs every single month being created. Immigration has slowed significantly, right, over, this year. So the break even to keep that unemployment rate is, you don't need to create as many jobs with less, you know, um, available workers coming into the workforce. So the unemployment rate stays the same. But the point is, this was a big shock, right? So ultimately, it's just showing that the economy is a little bit weaker. The employment, the dual mandate of the Fed is, full employment and inflation. So expectations today is that, you know, that they're going to cut the next rate. And we've seen sort of 2 years yields and 10-year yields drop significantly today. So that's the big news. And obviously I could talk about, what does that mean for the economy going forward? What does that mean for the stock market? And I'll just kind of do that real quick, right? We're seeing a big sell off. Is the market's been priced pretty much for perfection, right? It's the idea that
Yeah.
earnings are going to continue to grow and that tariffs are going to come in less than expected, and that the tax cut, the tax bill for next year is going to offset, and any tariff implications and even then some. And the reality here is, right, like I've been saying for a while that economic data is going to come in a little bit worse in at least the second half part of the year when tariffs start to implement and start to pass their way through into inflation data and a slowdown. Ultimately, I've been thinking that we're going to get corrections in the markets all year, and we haven't seen it over the past 3 months. So um, I guess here's my main thesis coming away from it is that overall, I think economic data will slow down. Um, the job issue is a big concern because of two things, right? Maybe that means the damage is already done from the tariffs, right? One way for uh, companies to pass on the cost or absorb the cost is by laying off people, right? Cut their own costs to eat some of the inflation without passing it along to the consumer. And then on top of that, we have the AI productivity gains, which also means that they can lay off individuals. So even though you get some productivity gains from AI, if more people are unemployed, that could take the entire economy down with it. I think though, starting to next year, if you start to look at some of the data with wages and employment and what the big beautiful bill will do, we'll start to see tax refunds next year support consumer spending. Businesses will, they'll lay off some, but not enough to be overly pushing the economy into a recession. And I think we'll continue to make highs again after some needed volatility, a little break in the markets.
Yeah. Now, I'm looking at the NASDAQ here down about 2.3%, right? And relatively speaking, I remember where we were at when the tariffs happened and how we saw a correction of almost 20%. If you're an investor, and let's say you're not part of our family office and you're just thinking on your own, for those listening, entrepreneurs or people that are hesitant about putting money in the markets, would you suspect that you could see another 8-10% in the NASDAQ correct? Tech is such a focus today that I want to ask about the NASDAQ since everyone's talking about that. Is it unreasonable to think we could see another 8 to 10% from the NASDAQ with the 2% already today?
It's possible. I mean, 100% is possible, right? I would say, I honestly, I'm hoping, to be honest, I'm hoping it's going to happen, right? Because I have some cash that I want to deploy for clientele because I'm still bullish in the long run. And I've been hoping for a pullback. Point is, I'm a buyer in that pullback. I probably wouldn't wait for it to drop to 8 to 10% to recommend individuals to start buying. If you're sitting on some cash, right? If we got even a 5%, I would start putting some of that money to work. I think, again, we're going to look through, just as we have been, all year, we're kind of looking through some of the negatives that we, in the back of the mind, even though the retail investors just keep buying, right? In the back of their mind, they realize that some of this could be happening, right? They had to know that tariffs could start to show up into the economic data.
Right.
And their thesis at the time was it's going to work out in the end, right? The tariffs are going to work out. We're going to get new capital inflows from foreign investors. And the tax bill is going to be a big, huge boom. Productivity and AI is going to continue to push earnings higher, and they've been buyer. I think it's just a little bit of a, it's pushed up so fast so far. Let's take a little break, let things reset a little bit, and we'll continue the
Right.
trend higher.
Speaking of pushing up too far too fast, Figma recently IPO'd yesterday, which is a big sort of, a lot of engineers use that. It was hyped. I know it's not something you're following too closely, but they had a list price of 33. Just to give perspective, it peaked this morning at 140 something. And since then, it's trailed back down to like 110. There's this volatility. But when I look at the broader AI spectrum, Nvidia as of today is like a $4.2 trillion business. Are we a little bit overly optimistic on this AI craze? Like when you're looking at this, are we too like are we pricing in that AI is just going to be that perfect at 4.2 trillion? And then you look at things like Figma or CoreWeave or even Palantir.
Um, that's a difficult one to say. I mean, so yes, it is pricing in significant growth for for a long time. And could it disappoint? Yes. I'm in the camp that I don't think it will, though. I think it will live up to the hype. Maybe individual names may get a little over their skis, right? Like of how much they're going to specifically benefit. But the money that is, you're just looking at every single earnings call that we've seen so far from Microsoft and Google, and Amazon, and Meta, they've increased, even more than the huge amounts they said they were going to spend on CapEx. They've increased it on this particular earnings call. So I think it's still in the early innings, and there's going to be enough growth. You have to watch out on individual names, diversify, don't play everything directly. So some things will get into bubble territory and sell off.
Right.
It's hard to anything trading at 100 times earnings is just like, it's insane. Could it
Yeah.
grow into it? Sure. But I possibly
Yeah.
wouldn't be putting too much money into
Yeah.
those areas. I just diversify it around.
I've been in many rooms over the last couple of weeks, just different events, business leaders, networking, and just even you, Kyle, you're a big gym guy. You hear like you can't help but hear about the Nvidia thing. It's 180. Where's it going next? 200, 250. To your point there, and this is not investment advice, so you're not making a recommendation, just for that disclaimer and disclosure. Are you thinking from your perspective, when you sit there like in a hat of a CIO, can you justify still buying Nvidia at like 180? Like if you're thinking based on your thesis, does that make it cheap 5 years from now? Like, or would you, if you're thinking of Nvidia, is that something like, man, I wouldn't even look at it till it dropped to 140 or 130? Like when you look at something like that specifically, that anomaly.
Um, so I'm not recommending individuals to go out and buy it at these levels. I own it, and again, not saying that which way someone should do with their own investments. But I own it. I own it in majority on the accounts. We bought on the sell off. I believe that the growth justifies, like, it's not there, compared to some of the other AI companies, it's not that crazy expensive based on its, earnings growth potential. However, and they're just a dominant player they are. However, could all of a sudden the entire dynamic shift? Other companies can kind of replicate what Nvidia is doing. They lose market share. And now you're, where it's priced for, you know, 30% growth, and it, still going to continue to grow, but that drops to more normal growth rates, and it doesn't justify the P, that is certainly a risk, right? So my point is, I'm still a believer um, there is no real contender to Nvidia at this point in time, and they will likely continue to dominate the market share, continue to grow into the valuation, which I don't think is that unreasonable, but there are those risks. So again, it's, I would say a lot of retail investors just buy based on momentum, and that can work for a while. Valuations do come into play eventually. These companies warrant a higher PE, but not just at any cost, right? So I guess the end of the day is back to that consensus of hold on to it. I wouldn't chase it. As we've seen this year, just a little narrative like the DeepSeek that comes out can be all it takes to get a little sell off. If we see those sell offs, then buy.
Yeah.
Then be a buyer.
And I try to look.
And know that, right, if just a lot of the average investor, if you're just putting some of your money away every month, you're buying, if you're buying the S&P 500, you're buying a lot of Nvidia because it's such a huge, part of it. So that should be enough of your exposure directly to Nvidia, in my opinion, for the average investor out there. Is just, buy some of the S&P 500, and you're getting, the largest weighting in your portfolio will be Nvidia in default.
Yeah. I think the other thing is I like to personally hear what other industry leaders are saying. I think they tend to be pretty smart, right? And so I was listening to the earnings call of Intel last week where they admitted the Intel CEO said, and he's a new CEO, we're not even in the top 10 of leading chip companies. You're talking about a historic brand, Intel, the money, the R&D, the chips that they've built. Not only that, he said that it's too late to catch up with Nvidia in the AI training market. Like he's saying that with the money that they have. And I think that gets to your point about Nvidia being the leader in it. Do you ever look at the competitors in the space, like in this specific category, Intel, AMD? Does that help sort of your decision making when you're trying to think of who's the best?
Yeah. Yeah. I mean, each of them have their own potential niches. And again, there's so much demand that, you know, they're all benefiting. So the point at the end of the day is, yeah, you never know who's going to be the, you know, 10 years from now. Is it the same trajectory going to be? Who's going to own the marketplace? Is there going to be certain niche? Is there going to be so much, um, you know, insane technological advances that, you can get away with a lesser product than Nvidia and still have a superior offering to your clientele. So at the end of the day, is right. The whole space is growing. You always want to look to see to buy the best, but I would diversify around a little bit.
Right. Right. And my last question here, given that we're coming up on time here, the conversation unintentionally turned into really just an AI focused one, which sounds like what everyone's talking about these days. But Figma, right? Figma just IPO'd. Again, we hinted earlier at the fact that they had a list price of 33. And, as of this morning, they were 140. Now they're down to around 112, 114, wherever they're at. I know you're not really looking too much at these new AI hype IPOs, but how should people think about seeing companies like this? It's hard not to, I'm sure you get called. It's hard not to see something that's up 4x since the IPO price and say, did I miss the boat? Like, how do you look at those things?
Well, I would say, right, there are plenty of great private companies that, obviously if you can get into and buy, they're going to turn into great businesses, and you want to own them. However, I'll sort of say, not saying that Figma isn't worth its valuation. I don't really know yet. Is kind of the main, context. I do put it a little bit into the camp of there's always, I'm not saying we're in a bubble because we're not in a bubble. I believe this all has legs, but you do put in the context of, right, we're seeing meme stocks again, become sort of all the rage and get huge, upward momentum. The retail trader, I think, is here to stay, right? So there's going to be times of things that just, IPOs, meme stocks, AI things that are going to get a little ahead of the skis. And the point is, yes, like, is it great to make a lot of money quickly on some of these things? And is there a way that you can be a formed investor and participate? There is.
Right.
More money is lost, though, usually trying to chase those trends than not, right?
Yeah.
If and a lot of people who used to do like the Wall Street Reddit, and try to see what tickers were trending and get in before, to see what the trend and the sentiment analysis and buy those stocks to get in ahead of time. Historically, by the time it's on there, it's already sort of too late. By the time it comes across your thread, if you really were sophisticated, the best way to track that is by tracking the volume of all these companies and trying to get when there's, systemic changes in the amount of actual, volume change. But
Yeah.
my point is, at the end of the day, like, yeah, you can do some play money, but I kind of throw the Figma a little bit into and some of the IPOs and, with the markets at all-time highs, companies want to go public. They realize this type of thing can happen, which is their stock price, and it probably gets a little bit ahead of itself. And I kind of throw it into that meme craze that don't chase it.
Right. Right. I mean, look at another example. You're probably familiar with CoreWeave. CoreWeave had listed their IPO at $40, which initially was going to be 55 in March. Remember, after they listed, they skyrocketed to like 60 or 70 on open, and they peaked, Kyle, on June 20th. They got to $183. Since then, since June 20th, it's down 44%. It's at 103. And look at that. That's in about 30 days, right? So that's to your point there.
Yeah.
Yeah. Well, thank you. That is this week's episode of Smart Money, Smarter Moves. As a reminder, if you like what Kyle's saying, please follow Freedom Family Office on socials. Follow Kyle on LinkedIn. You can subscribe to our email list by sending me an email at samir@freedomfamilyoffice.com. Kyle sends out weekly and monthly insights that are great for you to listen into. And if you're interested in becoming a client at our family office, email myself and email Kyle@freedomfamilyoffice.com. We'd love to have a conversation with you. And we'll see you guys next week for another episode of Smart Money, Smarter Moves. Thanks, Kyle.
Thank you.